Good morning, everyone, and welcome to our Climate Infrastructure Fund 1 launch webinar. Excited that you're all here. So let's get started at the dot 11 o'clock a.m. here in Amsterdam. So what can you expect today? So we will be introducing our first climate infrastructure fund. We'll walk you through the opportunity. We'll walk you through the strategy of this fund and why we're excited about it, and explain how it differs from our existing products. And at the end, we'll allow you some time for Q&A, of course. Some logistics: feel free to write your name and your role in the chat, make yourself known. And for Q&A, leave your questions, please, in the Q&A section, and we will either address them along the way, if relevant, or wait until the end. And there will be plenty of time for your questions. So what is the agenda? We will start with the climate infrastructure opportunity and how we define this and what it is that excites us about it. And secondly, we'll introduce our climate infrastructure fund and how we want to play in this domain. And then thirdly, we will explain how this compares to our existing products. We have obviously already some venture capital and private equity funds out there. This is a different strategy. So what are the differences and how should you look at the two of them? Fourthly, we'll explain you, for those of you who don't know Carbon Equity, how we operate and how you can work with us, how you can get started. And then at the end, we'll leave some time for the Q&A as set. So who will be presenting today? Besides me, it will be Eva, one of our investment team members. She is actively involved in sourcing and diligencing our investment opportunities. And also she brings a lot of technical knowledge, and she works on her in-house knowledge development, what technologies are needed to get to net zero, which are less needed, and that's also relevant for the infrastructure domain. So she will be presenting together with myself. I'm the managing director of the investment team, and where Eva brings a lot of the technical knowledge, I bring more of the general investment experience, and those two go hand in hand in our strategy. So let's start with the climate infrastructure opportunity. Eva, over to you.
Yes. Hi, everyone. I will take you along the tremendous opportunity for investment in the climate infrastructure space. So to start with, to keep temperature levels well below the 2 degrees Celsius, as called for in the well-known Paris Agreement, emissions need to reach net zero by 2050. And for this to happen, we need to decarbonize every sector. So think about the energy sector, industry, like cement and steel production, transport, but also food and land use, and the buildings we live and work in. So in this transition, we need to get rid of fossil fuels, obviously, and we kind of need to electrify everything. And that means we are going to need more clean electricity. And we have a population that is growing, and that means that the demand for electricity is increasing even more. And it is expected that we'll need 3 times more energy in 2050 than we do need today. So electrification of everything and decarbonizing the sectors that are hard to electrify requires new technologies. And for instance, to produce renewable energy and to store energy, but also to produce cleaner fuels, for example. This requires an extension of our energy grids, but also an extension of the infrastructure, for example, to charge our cars. So if we look at the left chart on this slide, we can see that between 2016 and 2020, we spent almost $2.5 trillion on the technologies and the infrastructure required to reach our net zero emissions. And in 2030, we expect it will be around $5 trillion in capital investments globally if you want to stay on track. So climate investments are a huge investment opportunity. And as we can see on the right chart, this opportunity will also show significant growth in revenues from 2020 to 2030, with a compound annual growth rate of 10%. So we move from 5 trillion in 2020 to 12 trillion in 2030. And this really highlights the climate tech sector that is expanding rapidly, but also steadily. So as I mentioned, we need $5 trillion in 2030 alone to flow to climate solutions to reach our net zero goals. But this capital needs to be invested across venture capital, private equity. The majority of capital will actually come from climate infrastructure funds. So where early stage venture capital, as we can see on the left side of this chart, entails the capital to fund the first prototypes and new technologies. So this is really the conceptualization phase of technology. For example, nuclear fusion, which is still really in the research and development phase. And then we need more private equity capital to fund first pilot plants and later stage production facilities that are really ready for commercialization. So green steel, for example, is a great example of that private equity capital. And once we reach commercialization, we need even more capital for a large-scale rollout of the proven climate technologies. And this is known as infrastructure capital. So with the help of this capital, we are really securing our clean energy supply chain. So what technologies are already mature enough to scale with this infrastructure capital? So 55% of the emission reductions that are necessary to reach a net zero economy in 2050 can be achieved by using the technologies that are already mature today. So as you can see here, 10% on the left side can be reached by already well-known technologies like solar farms and windmills. And 45% can be reached by technologies that are in the commercialization phase. So an example of that is energy storage with long duration batteries, improved grid infrastructure, but also production of biofuels. So these technologies are ready or almost ready to be rolled out on a very large scale and thus to receive infrastructure capital.
So I'll take it over from here, Eva. So it's a huge opportunity. Infrastructure is a critical component of getting to net zero. Now, within infrastructure, there are many different strategies. You can invest in just the project financing, in the debt financing. There are various types of debt financing, and those are really needed. We are really focused on climate equity infrastructure, so really equity investing within the infrastructure domain. But even there are three different strategies that you typically see, and I'll walk you through them because two are within the scope of what we think is attractive and one less so. So starting with what is not in scope, that is core infrastructure. That is buying equity, buying shares in existing projects that are in operation. It's being done by very large institutional investors. They just buy a wind park, offshore wind park that's in operation, and you achieve at relatively low risk single-digit yields. It's interesting, but not in scope for us because we like to focus more in investing in newly built projects. So every euro from our fund will go in developing and building new projects. And for that, there are two strategies. So Core Plus. With Core Plus, the projects have had either already the first steps of their development process. So land has been acquired, the permits are in place. It's just ready to build, and the metal needs to go in the ground. So there, the first phase of development is behind you. The initial risk phase is behind you, and it's really now building the new projects. That is in scope for us. We like it. It could also be buying an existing windmill and putting a more efficient, larger one in place. Again, the land is already acquired, the grid connection is there. It's just enhancing the efficiency of the project. That falls under Core Plus, and the equity returns for these type of projects are 10 to 12% net IRR. And once they have been revamped or built, after a couple of years, there will be some cash yield from all the cash flows that are being generated by selling the electricity or storing it for that matter. On the other hand, you have value add. That's a little bit more risky. That's really the full development spectrum. You start from scratch and you're looking for land, you start developing, and it takes more time to get there. A little bit more risk, but also higher equity returns typically for those type of investments. For each of these strategies that we look at, every euro is additional. It will result in newly built projects. So what could be part of that? An example, it could be upgrading existing renewable biogas plants, for example. That could be in scope. or developing green hydrogen plants. A little bit riskier. We haven't seen that many of it. The more obvious one are grid-scale battery storage in combination with large solar PV parks. This could be a mix of all those. So what are the characteristics of such an infrastructure project? First of all, many of these investments, the underlying investments, have contractual offtake agreements with high quality counterparties, and that secures long-term revenues. So there's a lot of stability and predictable cash flows once the projects have been finalized. And often these projects have an inflation linkage to it, so in the price mechanism. So this is essential infrastructure, reliable counterparties, and given this type of profile, the loss ratios of these type of investments have been extremely low, well below 5%. There's also no technology risk. These technologies have all been proven at large commercial scale, so that sets it apart from our earlier stage program. Now, it's not without risk. Of course, once you are developing new projects, there's development risk. Can you meet your deadlines in time, within budget? Can you construct it? Do you run into any issues on the construction side? And also going forward, can you actually attract sufficient financing to build out even more and develop even more projects? Obviously not without risk, but different risk profile that I will explain later than our early stage program. Now, one example of a company in one of the funds that we have in our pipeline that we're looking at is NW Storm. They are building a huge platform of battery storage, really modular battery energy storage, so 1 megawatt per unit, and they combine it typically also with fast scaling EV charging stations. And they are the market leader in France. They're expanding internationally, and they're off to a great start. This is just an example of what you could expect within our portfolio. At exit, they're really targeting to have a 2.5 gigawatt portfolio of generating assets or of storage assets in their portfolio. So it's sizable, it's large, and it's immediate impact. So let me now introduce our fund, how we want to approach this. It's very similar to the approach that we have on the venture capital private equity side. So we are a fund of fund. With your investment, pooled with other investors, we will commit to up to 5 climate infrastructure funds. And underneath those, there will be up to 50 climate infra projects and investments. So it's a diversified portfolio. And what are we looking for in these fund managers and these fund propositions? Like I said, we're looking for equity exposure within this domain. And it means the net IRRs that those funds need to deliver, or at least target, is 12 to 14%. And that's attractive. We focus primarily on the mid-sized funds, so ranging from approximately 500 million to 3 billion. There are many larger funds out there. We are more attracted to the mid-sized funds, especially from a sourcing point of view. We think there's more interesting opportunities with less competition. And also, once they are fully developed and they want to exit, we think it's easier to exit with many of the large funds out there. There are just more exit opportunities than for some of the very large funds where there's more dependency potentially on the IPO markets. Here, that's less the case. So we like the mid-market strategies the most. Obviously, they need to be 100% focused on the energy transition and on decarbonization. The benefit in infrastructure is that many of the teams have been doing this for a long period of time. So we're very focused on what they achieved in their prior funds, both on impact and from a return point of view. And the benefit of having teams that have been operating for a long period of time means that their processes by now have been highly institutionalized and the teams have been working together through cycles. So how will we construct a portfolio here? Always same for venture capital and private equity, diversification is important. So we want to have a balanced mix between the core plus and the value add infrastructure. Here it says 50-50, could be 40-60, but this is kind of what we're shooting for. And if you look at the underlying assets, this is good to understand, is that there will be direct exposure to the underlying projects. So equity invested in the companies that own the assets, as well as, especially in the value add side, invest into the developers themselves. So that's more the top companies who then are developing all the underlying projects. We will have a little bit of both. Infrastructure projects, a little bit less risky. Project developers add a little bit of so-called alpha, a bit more return driven, but it's both will be part of this strategy. From a geographic point of view, it will be more skewed towards Europe than the US. We see plenty of opportunities here in Europe, very attractive pipeline right now. But some of the funds have a broader investment strategy and can also make some investments in the US, and we don't mind, but it will be more focused on Europe. From a sector point of view, the vast majority is energy related. So this is generating electricity, it's storing electricity, but there's also some exposure likely to transportation. This is EV charging mostly. Small bucket for other could be potentially green data centers. Who knows? There is a likelihood that it could be something hydrogen related, but it will be a small amount overall. Eva, can you walk us through one of the funds in our pipeline, just so that people have a better flavor for what it is we're looking at?
Yeah, sure. So I will introduce you to the first opportunity we're currently looking at, and that's Infra Green 5. So that's from the fund manager R Green. And R Green is an established manager based in Paris, raised 5 funds to date already, and have 2 billion euros under management. So a really established manager. They were founded in 2013 and have a real core focus on the energy transition. And with this 5th fund, so that's the fund we're also looking at, with a target size of 1.2 billion, they want to invest in ready-to-build projects and also in its developers of the projects in Southeast Europe. And these are often regions with a very high CO2 intensity of the grids. So these developers can really make a big impact there. And R Green has financed almost 5 gigawatts across over 3,000 projects to date already. And their preferred return structures have provided strong downside protection of the assets as well, resulting in a 0% realized loss ratio. And Infra Green 5 has made 6 investments to date already, so we have quite some visibility on the portfolio. And I want to highlight 2 examples. So the first one is Eco Energy. They have over 200 solar and storage projects under development with a total capacity of around 7 gigawatts. And these projects are based in the UK, Italy, Romania, Poland, Spain, and Greece, so well spread. And they will use this fresh capital to support development activities of the firm Eco Energy in the UK, really to support until the pipeline of the projects are ready to build. And then the second example is Swish. And Swish is an EV charging operator, infrastructure developer, and constructor in France. And they focus on like small to medium-sized businesses to like put infrastructure in place there. And they have secured around 250 chargers to date. And by 2030, they aim to install 80,000 chargers. So this capital is really used to support this growth ambition. And then the second pipeline example is Sven Capital Partners. And they are raising their 3rd impact fund, and that is Swift 3, which is fully focused on hydrogen and biomethane projects. And this is really a value add infrastructure manager that could invest in both the developer as well as their projects. And this firm has existed since 2008, so also a very established partner, and have been focusing on hydrogen and biomethane in particular since 2019. They have quite some strong expertise on board to assess those projects. And with 8 billion assets under management, like I said, it's really an established firm. This fund aims to raise 1 billion. And yeah, it's really helpful from an impact point of view, because they invest in hydrogen and biomethane, which can be used as an alternative for fossil fuels, where electrification is not always possible. So, for example, in industry, their track records consist mainly of biomethane projects and some hydrogen projects as well, and they deployed 500 million to date in these types of projects. So now moving to our full pipeline. This pipeline really contains the funds that are currently raising and in scope. You can see that these funds are all really established managers. Some raising their third fund, some raising their seventh fund already. So there's plenty of choice we see, and there's a healthy balance between value add and core plus infrastructure managers to choose from, that invest in Europe or even globally. So we'll now hand it over back to you to tell us something about the cash flow.
Yes, thank you, Eva. Yeah, so the cash flow profile, we get typically a lot of questions for people. So what can I expect? So infrastructure funds have a slightly different profile than the venture capital and growth equity funds that we see elsewhere. First of all, they require a little bit less time to deploy, so they're a bit faster. Say within 3-4 years, the majority of the capital is really deployed, whereas in venture capital it could take a little longer. And then from year 3-4 onwards, you can expect already the first couple of distributions, just cash yield from dividends out of the projects. So slightly faster deployment, faster return of capital, and then the range of outcomes, it's narrower. We focused here on money multiple. I think IRR is also a relevant metric. The range of outcomes is, given the stability of the projects, is much smaller than you would see in venture capital, where if you do well, if you huge outperformance, but if things don't go well, you can lose money. Of course, you can lose money here as well, but the range of outcomes is really narrower. Just to give you a feel for what kind of return should you then be looking at, we've here highlighted 3 different cases. That's really driven by the money multiple that those underlying funds could achieve. So our base case is they will get close to 2x before the fees and expenses of those fund managers and before the fees of carbon equity. But in the downside case, it would be 1.75, just for your reference here, and for the upside case, 2.25. And here you can see what that then results in on a net basis at the bottom left corner for our investors, if these would be the outcomes of the underlying funds. And there you see the net IRR sensitivities ranging from 7%, things are not going that well, up to 13%. But this is not a 0 to 30% type of opportunity, much more narrow. Now, what have we assumed for this case? A ticket between 100,000 euros and 500,000 euros. So that goes with certain management fee assumptions. That's what's been driving in these returns. If you commit with higher amounts, then the returns will increase because the fee load is slightly lower. So what are the terms and conditions of our fund? So we are targeting 50 million for this fund, and the 50 million will be used to commit to up to 5 underlying funds. These are all Article 9 funds. We will not compromise on that. We think, especially in infrastructure, they should be able to hit all the requirements under SFDR to be Article 9 compliant. The setup fee is 1%. 25% discount for recurring investors. And similar to our other products, we have a ratchet of fees depending on your commitment size. The minimum commitment is 100,000 euros with certain exceptions. It's 200,000 for German semi-professional investors. And it could be 50,000 euros for qualified professional investors. So how does this compare to our existing program, the Climate Tech Portfolio Fund, where we're raising the 3rd generation right now? We're in the market with that one. Now, the Climate Tech Portfolio Fund is a more diversified portfolio. There we target 7 to 10 funds, especially even riskier. Their diversification matters even more. Climate infrastructure, given the different risk profile, 3 to 5 is sufficient. Geography, it's more Europe on the infrastructure side, the venture capital side, it's more US, given that the opportunity set on the venture capital side is larger in North America versus the climate infrastructure sides. So what does that mean for the portfolio of underlying investments? On the climate tech portfolio fund, there will be 150 to 200 exciting startups and scale-ups ultimately in a single fund. Whereas in climate infrastructure, it will be more limited. It will be 40 to 50 investment projects, either directly into the assets or through developers, but it's a more concentrated portfolio. Still highly diversified, but more concentrated relative to the climate tech portfolio fund. From a risk point of view, that's the biggest difference. The climate tech portfolio fund, there's a lot of technology risk still. Many of these investments are really early in the journey. Some just out of universities, spin-outs from universities, other at pilot plant phase, others beyond that and scaling up. But it's really more, there's more technology risk. Climate infrastructure side, that tech risk does not exist. It's more development, construction, and financing risk. So the target returns, therefore, are different as well. So on the climate tech portfolio fund, our target returns is really to achieve at least 2 times net. And we think if everything goes according to plan and people care about transitioning, then we're really, really ambitious and want to hit that 2x. Could also be 3x if things go well. Could also be lower if things don't go that well. So the range of outcomes there is much higher. Climate infrastructure, it's narrower. 1.4 on a net money multiple is the base case, but we really want to achieve that 10% net IRR. That's for us important, really the key focus area for our product. In a downside case, you're looking at high teens, upside case, somewhere mid-teens, but that's kind of the range that you could expect. Less volatility there. Distributions. The climate tech portfolio fund takes a little bit longer. This is deep tech. Exciting breakthrough moonshots could be fantastic, but will take longer to develop. On the climate infrastructure side, it's really building and putting new battery storage in place at larger scales, and that can be done within a couple of years. Now, the impact Eva already explained, we need both. And the impact on the climate tech portfolio side could be humongous if things go well. On the climate infrastructure side, it's impact immediately, but it's limited to that particular product. So the scalability beyond that project is, of course, limited on the infrastructure side. On the deployment side, on the climate tech portfolio fund, it takes longer to invest everything. With especially in venture capital, you start with a small investment, and if the company hits all the milestones, then you will have follow-on investments for the rounds thereafter. But that could take up to 7 years. Climate infrastructure side, the vast majority of the capital will be deployed in the first 4 years. So the capital calls therefore also take a little bit longer on a climate tech portfolio fund. And the climate infrastructure fund, we expect the vast majority to call the vast majority of the capital within 3 to 4 years. So in a nutshell, why are we excited about this? It's really scaling up proven climate innovations that we need to get to net zero. And by doing it, the cost curves drop very fast. So we see the same thing happening right now with battery storage. The cost price are really, really dropping, and that makes it super attractive to adopt more and scale up that technology. We want to see that happen in other technologies as well. So particularly interesting for this fund is that we deploy your capital faster and you get cash proceeds back sooner than in the climate tech portfolio fund. There's no tech risk, but you will have direct impact with your capital once a project is operational. Once the solar PV plant is up and running, once the hydrogen plant is up and running, there is immediate impact. And it's a balanced risk return profile. I think especially for the lower risk, achieving, at least targeting double-digit IRRs is attractive. So how do we operate? Eva, can you walk us through the strategy?
Yeah. Sure. I thought maybe before we dive into how we do things, there were 2 questions in the chat more on the strategy side of things. So the first question is coming from Eva Jan. The question is that decreasing carbon emissions is important, but it will not solve the current carbon in the air. We need to make the soil absorb carbon in a meaningful way. So how will you solve the latter with the fund? I think I can give a brief answer to that question, because we do believe at Carbon Equity that it's really important to decarbonize all the sectors as much as possible, but we also need additional measures to remove carbon from the air to really reach net zero. And you can do this with natural-based solutions, like Eva mentioned, carbon sequestration in the ground. And for infra, we see this happening actually with assets where developers produce bioenergy, for instance, and at the same time can store or capture and store the carbon that is released by the process in the ground. So that's that way you remove carbon from the air. Another way to do this is more artificial way, and that's by direct air capture. So there you also remove carbon from the air, but this tech is really still underway to become mature enough for infrastructure capital. So we don't see that a lot in our infrastructure funds we look at, since it's still risky, but could potentially happen. And then the other question was from Willem Roos, that we need a lot of new technologies and also replace feedstock of fossil fuels with bio alternatives, I assume. So what are the trends we're seeing there, and what are the alternatives for feedstock? Can also give an answer there. So we indeed need different feedstock. But it's really important. We spend a lot of time here at Carbon Equity also to understand where that feedstock is coming from. So it's also a risk, because there's currently not enough feedstock available, or there's a risk that the supply could be bigger, or that the demand could be bigger than the supply. So what we see here is mainly that feedstocks should really use sustainable biomass or agricultural residues, so like straw and husks, and forestry residues, so that could be branches, and dedicated energy crops to produce energy. But what we should keep in mind here is that we should focus on the crops that minimize land use requirements, and that we should exclude biofuels that are derived from crops that we can also use for food. And we should prioritize biomass for the sectors where really no alternatives are available. So also if we look at funds, we need to make sure fund managers keep this risk in mind. So now moving to how we operate. Let's see. So at Carbon Equity, we start with, on the left side, for this fund strategy, we have identified around 150 funds that could potentially be in scope for this infrastructure strategy, and that are really active in raising and also in deploying capital. So we always start with doing initial analysis, where we scan a fund's climate strategy, its team, track record, and also the terms on a high level basis. And then from the quick scan phase, we really move to our climate impact due diligence, when there is sufficient support to proceed. So at this point, we really dive deeper into a fund's climate strategy. And for infra funds, I think this means particularly looking at the sectors and the technologies the fund invests in. But I will elaborate a bit more about on that later. So then we move to our general due diligence. No worries. Including the financial due diligence. We'll also elaborate a bit more on that later. And at this point, we also do our environmental, social, and governance and SFTR analysis. Even more important for infrastructure funds, because we're talking about big projects. You want them to have the ESG measures in place well. So we check that on a fund manager level, but also how they incorporate ESG measurements in their due diligence. And eventually we expect 3 to 5 funds to land at our investment committee, where we need an unanimous voting. So now a bit more in detail on how we do our climate impact due diligence. So for this, we use our proprietary scorecard, and that we have developed in-house. So we really use this scorecard to assess the level of impact ambition of a fund manager while benchmarking it against the global best practices we've seen to date. So how we do that, we look at 5 topics mainly divided into several key items. So we start with the mandate, and there we really assess what's actually the fund manager's strategy from an impact perspective. So are they really fully committed to reducing greenhouse gas emissions? And then we move to the organization. We assessed our climate knowledge and how they have structured their impact processes internally. And we also look, of course, at how they make their investment decisions. So how they source the deals, how they assess the sufficiency of the impact, and what is actually enough impact for them. So some questions are here, do they quantify potential emission reductions prior to investing? And do they actually ensure that all investments are net zero compatible? And for infrastructure assets, we see that we particularly like that a fund manager uses the EU taxonomy, for example, in Europe as a guide to invest in technologies that were really aligning with a net zero economy. And then post-investment, we look at how the GP reports on impact and how they help the companies or assets with managing impact. And as equally important as these 4 topics I just mentioned, we also do a bottom-up analysis to assess the investments that are made by the manager in the past. So, for example, to check if we believe that these investments are truly meaningful and really building blocks we need for a net zero economy. And yeah, we often walk through multiple investment cases with the fund managers to really understand the impact thesis of these investments and to check whether that aligns with ours. So eventually, each item on the scorecard we receives a score, and then we have a weighted average final score that should be above our minimum of 3 to invest.
Thank you, Eva. And then once a fund passes that critical impact scorecard phase, we move on with more the general diligence. And this is whatever institutional organization will do. You look at the team, the quality of the team, how have they been working together, what is their track records, is it balanced, do we get positive reference calls on the team? Very important. The good thing here is they have been around for a longer period of time than we see typically at the earlier stage. So there's more stability. The organizations therefore are more institutionalized, so that helps our work clearly on the infrastructure side. But we check everything. We go through it. Who do they work with from an advisors? Who are their limited partners? And that says something about how institutionalized and how high quality their organization is. We dive deeper into their investment strategy, also from a general point of view. How do they source investments? How has that been set up? Is it thesis driven or reactive? And how do they add value? Very important, especially at the core plus and value add side of the equation. This is critical to understand how is it that they operate. And then finally, the fund terms. Size, how's the fundraising going? What are the economic terms, management fees, and carried interest? Pretty standardized. We don't see many different flavors here. So that's also an advantage of having many institutional large LPs investing in these type of funds. And where we do spend quite a bit of time on, and especially with those funds in infrastructure where they have already a seeded portfolio, is zooming into the existing assets. And I really want to make sure that whenever we enter a fund that is for 50% funded, that those assets are performing, that they're out of the gate strongly, that the developments are on plan, timely, within budget. So we try to have calls with the especially from the larger value drivers within a fund, with the company CEOs, so that we really understand what is going on and is the traction there? Are they off to a good start? We discuss with the manager what have they learned in prior investments and how are they implementing that going forward? Also very important, and we want to see proof of that. And we look into the valuations. What are the entry valuations of the portfolio, and do we think it's reasonable for these type of investments? So a lot of work goes on with really vetting the existing portfolio, and that reduces the risk ultimately. builds our conviction. So the team investing this fund is on this page shown here. It's a stable team. It's the investment team. We have been reviewing fund managers within the climate domain with this team now for 3 years consecutively. And we have the in-house knowledge to really assess whether a fund has all the right things in place to deliver. And again, as said, within infrastructure, it's a little bit easier given that they have so much track record. So that makes our life a little bit easier. But then it's really comparing and contrasting what excites us about one versus the other. Yeah, so carbon equity in a nutshell, by now we have close to 1,000 investors on our platform. We have raised 250 million. In our earlier stage program, we have 150, well, more than 150 companies through the underlying funds. So we're really now becoming one of the more established players that helps us getting access to the best funds. Yeah, this is just a start. We're ambitious. We want to get to the billion as quickly as possible. How can you get started? As a next step, create an account if you haven't one already. You will receive the email after the webinar. Review all the information on the fund if you haven't done so already. And if you'd like, book a call. We're more than happy to walk you through the proposition again or answer any questions you might have. And then once you're happy and you understand all the risks and the attractions, reserve your investment with us. Yeah, that brings us to the Q&A. Eva, are there any questions?
Yeah. The first one is, why do we exclude co-investments? Could you elaborate a bit more on that?
Yeah, on the infrastructure side, we don't make any co-investments. These are super sizable projects. So for a co-investor to be meaningful enough to be investing in this space, you need to bring in a lot more capital than we could bring in. So it's just not relevant to come in with, let's say, a very small ticket of 1 million in these very large investments. Typically, these are 50 to 100 million investments. That's very different than in the venture capital program, where some of the initial tickets are maybe a couple million. And there we can be material with a smaller co-investment, but on the infrastructure side, we're just not big enough yet.
Great, thanks. And then another question coming from Jeroen. Not sure, maybe it's answered because we had a slide to compare our core product or the VCPE program to this one. But is there any overlap in strategy between this fund and our core fund?
No, this is a really different proposition, no overlap. What you could see is that a technology that is being developed in the early stage program one day becomes a investable opportunity on the infrastructure side. So you see a lot of lithium-ion battery storage projects. They store energy for 4 hours. We have many exciting long duration opportunities in our early stage program. One day, hopefully, they will become grid scale and investable, and we'll see deployment also on the infrastructure side. But right now, there's limited overlap.
Great. And I think final question is, does the definition of infrastructure also include natural infrastructure? And yeah, examples are seagrass, mangroves, etc.
It's not what we are focusing on. We don't see any fund opportunities in this domain, this type of with this risk profile and return profile. Maybe one day, once it becomes a bit more proven at larger scale, sure, but I think it's a little bit too early for that.
Great. I think those were the questions. Checking one more time. Yeah, I think that's it. So if there are not any more questions, I see something coming in. Any emerging market focus?
No, within this fund, not. So we only focus on established markets from that point of view. So OECD countries, there's right now plenty to choose from. So I'm not excluding that maybe one day we will launch a emerging market focused strategy, but this one is particularly focused on mostly Europe and some North America. Could be some global exposure to countries in Latin America, but not a emerging market only fund. That will not be part of this strategy.
Okay, helpful. And then 2 questions were more about where we can find this presentation. I think the answer to that is to go to our website and log into our app and then download the general infrastructure presentation. That's a lot overlapping with this one. So that's it for the questions. So if there are not any others, then I think we can wrap up.
Yeah, wonderful. Well, thank you for attending. Feel free to reach out. We're happy to chat, and but really appreciate you making the time this morning. So thank you for your interest, and have a wonderful day.